Okay, and we're live. Welcome, everyone. Welcome to the Home Run. My name is Jonathan Vasquez. I am a product manager at Beeline Loans. I basically help build all the amazing technology that powers our lending platform. Today, we're talking about the roadmap to finding and unlocking loans to maximize your rental returns. We have an amazing guest, Dan Jurkovich. But before we get started, there's a couple of housekeeping items. There we go. So your takeaways today, we'll be covering some of the following topics. One, what are the market trends in the investment world? What are today's investors doing? How an investment loan is different from like a primary home loan or a secondary home loan. How to leverage your income and assets to acquire an investment property. What are the steps in that process to qualify for an investment loan? And then finally, how to get access to a great loan, the best rates, and reduce your closing cost. Quick disclaimer before we continue. This content is for informational purposes only and does not constitute financial or mortgage advice. Please, if you have any questions about our products or any mortgage products in general, we'll give you our contact information at the end, or you can visit our website at makeabeeline.com. So with that out of the way, let's roll. John, how are you?
Hey, I'm doing good. And yourself?
I'm great. I'm super excited to have you on. I know we've had a few conversations on this topic offline, and I know you're packed with knowledge. So I'm looking forward to getting as much of that out of you today as possible. And I know our audience is super excited as well. So before we get deep into the topic, why don't you tell a little bit about yourself to the people watching? How you came to Beeline and how you got into the mortgage industry.
Sure. So that's a really long story. Essentially, I kind of ended up here by default. Graduated from college with a degree in exercise physiology. Went and started doing personal training and lifting weights, right? Like being a knuckle dragger. And that was all good and everything, but decided that I wanted more. So went out, tried to go into pharmaceutical sales and was told that I lacked the sales experience. So I had a personal training client that worked at a small company at the time called Rock Financial. They had just went public. Everybody told them that nobody would do loans via the internet. It was a crazy concept. Went to work at that company. The plan was to put in 1 year of time, get the sales experience, bail out of that dirty, slimy mortgage industry, and go and sell drugs. 1 year later, I'd made over six figures, was pretty dang good at it. Had been interviewed and had met guys like Dan Gilbert, just a lot of people today that, right, like super influential, tons of billionaires that were in and out of that company at different times. And started my path there. Within a couple of years, I was running a branch, ran one of the largest brick and mortar retail branches from about 2002 to 2005 or 6. At that point, went over full-time into the Quicken Loans world. So Rock Financial became Quicken Loans. Quicken Loans became the Rocket Mortgage that you know today. Was there through about 2012. The last few years there, I oversaw a program called Rumpelstiltskin, and that was during the mortgage crisis and kind of helped navigate and really like kind of set a trajectory there inside of Rocket Loans that turned into a lot of different things today. And from there, went into the private equity space. I had a couple-year non-compete, worked at some hedge funds, did some different things inside of the real estate market, and then I've been with a couple of companies since, have known your owner for years at Beeline, and he tapped me on the shoulder to come over and help with sales, help with generating revenue, kind of just help with programs. And I like to say that I touch all things from hello to thank you for closing. So that's kind of what I do at Beeline.
Fair, that's awesome. Thank you for that. Obviously, you started in the fitness space. I know you're still big into fitness. I heard that you're trying to live to be 100. Can you tell me more about that?
Yeah, so I have, as you kind of go through life, you have to have a purpose. And if you don't have purpose, right, like you kind of peter out. So a few years back, I like really kind of redefined my life. I have it someplace here. I actually carry a book around. Here it is. So I have this thing that I call my Project 100. So what I did is I went through and I mapped out where all the important people in my life today are going to be at when I'm 100. And right, so my oldest son is now 19. I think he's going to be right around 70 years old. So I start mapping these things out. Where are they all going to be? And then what do I need to be? So my projection is I'm going to have kids between the ages of like 55 and 70. I think that I hopefully have a bunch of grandkids, but there should also be great grandbabies there. So what I'm doing today, I've put my goals in place of things that I want to do at 100. I need to be able to pick up a 30-pound kid overhead. So like, that's a big thing. I want a grandchild to be able to run at me and like pick them up. I still want to be able to walk 5K. I want to be able to hunt alone. So I'm a hillbilly from Northern Michigan. We like to hunt, but I want to still be able to go out there and do those things, jump off of a boat, a whole bunch of things. So I kind of, when I wake up every morning, my number one goal is to set myself up and do those activities that will put me in place to live to be 100. You got to work and you got to make money because you got to spend money. You got to take care of your fitness, eat well, treat the people around you well. And ultimately, I feel very confident today, short of getting run over by a bus, that I will make it to 100. And I'm not just going to make it there. I'm actually going to be like lively at 100. So that is the goal. That is the plan. And it's what I aspire to.
Nice. Well, that is an awesome goal. And I love how detailed your plan is and that you have a notebook. Thanks.
Hundreds of pages of things about like getting 8 hours of sleep, book from Scott Walker, just all kinds of stuff. It's a focus. Let's just say that. It's the goal.
That's awesome. I mean, that's definitely inspirational. So let me ask you a question. Since you're so goal-oriented and obviously very organized, how do you take that into your conversations with our clients when you're talking about mortgages?
I think that a mortgage is, and I'm not that organized. I fake it well though. But I think that a mortgage is relatively simple. There's some basic underlying premises that kind of is overarching, right? The lending world works on one really simple premise, and that is that risk equals rate. So if you can just get that in there, right? And there's always a finite amount of money to lend. And from there, you have, right, the banks are going to lend what they have. If they have $1 billion, $1 billion will get lent. And they're always looking to lend to the most, whoever's going to pay the most at the highest yield. So they're always looking at that risk equals rate thing there. So, goals, it kind of all boils down to that. And then having a very succinct sales process, you're looking at the exact same things every single time and really trying to make sure that, while my goals are super important, your goals as the consumer, the person buying the loan, is equally important, right? God gave us all 2 ears and 1 mouth for a reason. We need to listen, figure out where you're trying to be. And as you're talking to, especially people in the investment space, it is really hard because I'll talk to one person. They've got 2 young kids. Their goal is to buy 2 investment properties that will cash flow for the next 18 years. And that's how they're going to pay for their kids' college. I've got somebody else that's, I was talking to a guy the other day that's been with Amazon for years, and he's just kind of fed up with it. He's got a bunch of money in stock, doesn't know what to do with it, trying to rechange his whole career. And investment properties is his way of going about doing it. So everybody you talk to kind of has a different set of goals. And our job on the side of sales is to mirror their goals with the closest program that fits. And you realize everybody wants a 0% interest rate and no closing costs and no payment. Right? Everybody wants the same thing. What we have to sell or what we have available is often there's a gap between that, and it's filling those needs, filling those niches, and then coming in, with the best and most competitive pricing that you can. And I've been saying the same thing since the late 90s. Literally, like I say the same thing on the phone today, 25 years later.
Fair, definitely a long trajectory. So I want to go back to that point a little bit. You mentioned risk equals rate. So when it comes, obviously, when we look at a primary home versus an investment property, we're going to look at that risk differently. So can you go a little bit into what are some of the differences between looking at an investment loan or an investment property versus, say, a primary home in terms of risk?
For sure. Let me start with the excuse me, I have a cold. Let me start with the primary. Pretty much on a primary residence, we look at 3 things. We look at your income. Want to make sure that you make enough money to cover the house payment. That's always a good place to start. We look at your credit. How you've paid your bills in the past is indicative of how you'd pay in the future. And then lastly, we look at your equity position in the home and kind of the overall quality of the home, right? So we want to make sure you're not buying a dump. It's not going to fall apart, because all those things, any one of those pieces missing leads to, foreclosures and those kind of things. So those are the 3 pieces that we look at there. As you move over to the investment side, it kind of becomes the wild, wild west. So I have programs where your income doesn't matter at all. The credit score buckets get really wide. because we're more concerned with, especially in this thing that's called the DSCR loan, maybe we'll get to that later, but they're only looking really at the asset and very little at you. Outside of that, you may be signing a personal guarantee that in the event that that thing goes bad and you have to sell it, maybe they come back after you for like a missing piece or something. I would say odd because you're putting enough down, but that's the biggest thing. It's one is very heavily burdensome on you as an individual and your qualifications. And the other on the investment property, it moves kind of more over to what is the house going to do? If I take this house back, will it continue to cash flow for me? So that risk equals rate equation's a little bit different. And they're also getting in a lot of cases a higher rate. So there's greater yield. So there's a greater, like you think of the mafia, right? There's loan sharks out there that will lend people, 20%, and they take your leg if you don't pay. We only take the house and it's never 20%, but that equation's always in play, and everybody's going to have a slightly different profile. There's not necessarily two that are the same.
Fair, that makes sense. So thinking about reducing risk, you mentioned that there are some loans where we don't look at the person's income at all. We just look at the income for the property. So, normally if I go to buy a primary residence or even a secondary home, I'll have to provide, pay stubs, W-2s or 1099s. What kind of documentation, how does someone prove that this property will actually bring in that income that they're saying will bring in?
So there's, like when I say this, everything's a caveat and the market's constantly changing. So what's here today may be gone tomorrow. We actually recently saw a player in this space. They went out of business and it kind of sent ripples all the way through the market. Like everybody reevaluated. Everything just became a little bit more risky as a result of that. So there was a lot of shuffling. But what they look at primarily, so let's say you're going to go and you're buying a house in Florida that's on the ocean and you're going to do an Airbnb for it. There's a couple of ways that they would look at it. If we know you put a long-term tenant in there, that's probably less risky in today's world than an Airbnb that's rented every weekend. Somebody could show up there, throw a massive party and tear the place apart. So that makes it more, that short-term rental becomes more risky. But we're going to look at whatever would cash flow on that property. The less risky those cash flows are, we look at that against what the payment would be, principal, interest, taxes, and insurance, and we do a ratio. And for the most part, we have programs right now in that space that can go down as low as about 0.7. So you could have a $1,000 payment a month and only bringing in $700 in rent. You could be in the game. And then all the way up, right? The higher you are, the better you are. You kind of stop getting benefit. You're not getting a better rate once you kind of go over like 1.5. It's kind of where it peters out. And we have that program with as little as 15% down. Just keep in mind, the more you put down, the less risk it is. Therefore, the cheaper the pricing you get.
Gotcha. That makes sense. No, that helps a lot. I guess the follow-up to that is, since we're looking at the property, where does the person's individual credit score come into play? If I'm buying a primary home, a credit score is one of the key things we're going to look at. But if I'm looking at an investment where the property is the income, what does that do in terms of credit score?
If you can be, I'd say ideally above 640, we have a variety of partners we work with, like multiple. I think we may have one that goes down to like 620, but you need to put 35% down. So again, there's always a risk. You put enough money down, the credit doesn't really matter. And then you start looking at, right, somebody that's multiple bankruptcies filed, those kind of things. Like there may just not be a program for them, but they often also don't have any money for a down payment. And most of the time, the individual is just doing a personal guarantee. And a lot of these loans we do in the name of an LLC. So we're closing them as a commercial mortgage. So it's a commercial loan against a residential property. And we have loans that go from, if you want to do one unit, up to 29 units. So you can buy small apartment complexes. We can do loans on like assisted living homes, adult, care homes, those kind of things. We're not doing the 275, American home, big, sprawling things, but somebody that's running something small like that. We've got a lot of options and we're expanding our criteria every day.
Gotcha. That actually brings up a couple of points I want to talk about. But the first one I want to chat about is the number of programs we have available at Beeline. off the top of your head, if you had to throw a guess, how many different loan programs do you think that any one of our clients would have access to by working with us?
Oh, I mean, individual options. So within most option, right? Like if I just give you one option, we have it with 0 prepayment penalty all the way up to like a 5-year prepayment penalty. So right there, you're looking at 5 or 6 options just within each program. And then there could be literally 100 options that we have to look at to determine what's the best program. And one of my things when I came on here was, like Fannie Mae and Freddie Mac, they put everybody into this small box. And either you fit into the box or you don't. And a lot of lenders, and I'm thankful that we're not this way at Beeline, they don't want to get outside of that box because it's hard, or their tech doesn't work for it, or it's going to, bother Susie in the processing department if she has to learn another thing. What we found and kind of our approach has been, this market's different in a bad way, but also different in a good way. We believe that we can take market share and kind of help out a wider swath of people if our goal is to just have every product under the sun. So aggressively, constantly looking at a good portion of what I do day in, day out is trying to find and fill those niches. In a refinance boom, there might be 1 million transactions happening a month. We're probably closer to the 200,000 a month right now that go through. And of them, I just saw the existing home sales came out for last month. So of all the transactions, you've got a whole bunch of people that are battling for 25% year over year. So 25% of all sales were cash. So that's out of our mortgage equation. There's another 16% that are investors. And of that 16%, most of our competition and the other lenders out there are trying to put them into their 1 or 2 products. I don't want to give you the product that's best for me, right? I'm a goals guy. I want to make sure that we deliver the product that's best for you and your family. And I think that often people make the assumption that because they talk to somebody, they're getting, sound advice. And we really believe like one of our biggest things is that 5 stars matter as a sales, right? We want to make sure that we win every client. Even if we don't do a deal, I want to make sure that we gave you 5-star service across the board. Does it happen all the time? No. Is it our goal? 100%. And so if we give you an option and it doesn't make sense or you find a better price, so be it. At least we can go to sleep at night knowing that we put our best foot forward and we tried as hard as we could for every client out there. And we've been being blessed by the fact that people are returning. They're doing 2nd, 3rd, 4th, 5th loans with us. We've got a lot of partners that send us business just because we do a good job.
That's awesome. I mean, I got into real estate in 2013. It was the first time I really came across the whole idea of investing in real estate. And, back then I probably got exposed to maybe 5 different ways to get a loan to buy an investment property. And since I came to Beeline, I feel like that number of options has grown to probably in the hundreds, like you mentioned. So definitely a lot of options out there. I want to really back a little bit to credit because we were talking about credit. And you mentioned that obviously based on your credit score, your down payment may have to vary, right? So you may need a bigger down payment based on your credit. Again, kind of going back to primary residence, for my down payment, there are things that I can and cannot do, right? It's usually you can't borrow money for a primary home, for a down payment for a primary home. What applies from that loan type to the investment loan and what's different, right? How does that change in terms of what you can use and can't use?
So funds are funds for the most part, right? If you go and borrow a bunch of money, we want to know that you as an individual or the LLC, right, that there's skin in the game. Usually somebody that, you've saved your money for a couple of years and you put it in, the chance of that, being a good loan is better. So there are usually some seasoning requirements. They want to know where the money came from. Not quite as restrictive though, in that they don't care if you can pull an equity line out on your primary residence, which you can do that conventionally as well. As long as the money's there, it's seasoned, it can be tracked and it makes sense. You're probably a little bit more liberal, or if you have an LLC, one of the partners of an LLC can sign as long as they own 25%. And the other partners could have right, you could have 4 people that are in on the property, one person signing, and right, you can't get gifts from your buddy to buy a conventional home. So it's probably more wide open. And I would really recommend, we could sit here and spend the next 1 hour talking about all the subtle, one-offs. I think you really have to just, when you get into this and you figure out your situation, or what you're looking to do. I think that it's really important to talk to somebody, whether it be us at Beeline or someplace that really understands this, and they look at your whole portfolio. And if they stop at how much is in your checking account and what do you want to put down, if that's as far as they go, I'd equate that to a doctor, like putting his hand on your head and writing you a prescription. Like there's a lot more parts that need to go into that.
Fair, that makes sense. Before we keep going, I just want to mention we do have a Q&A section on the right side of the screen. I see some questions coming in. We're going to answer them at the end. But if you got any questions, whatever is going through your mind, just please type it in and we'll get to them in a few minutes. Let's talk a little bit about seasoning period with the down payment. It's kind of continuing down that conversation. So usually for again, primary homes, we look at usually 60-day requirement. For investments, does a seasoning period apply? Is it kind of all over the place, just like you mentioned?
Depends. So there is not a cut and dry thing there. I would say that anybody that's listening to this or on here, if you know that this is something that you'd want to do, I would always encourage you to start getting your ducks in a row. Set up an LLC if you want to buy it in an LLC. Start looking at particular areas, what the cash flow is going to be like, spend some time in Excel or sheets, running some models, right? Like come up with a very solid game plan. What I see a lot of people doing, they get frustrated. It's because this is not something like you should put a little bit of time into this before you just fly by the seat of your pants. Are you going to take care of the property preservation yourself? Are you going to hire somebody? Is it a condo association? Right? Like there's just so many parts. I think that you have to just put a little bit of time into it. And I would say move the money today. Do those kind of things, get it kind of all pulled together. And if you're like pulling money out of your 401k, right? That's legal. It's your money. You can take it from there. Do that. There's things called self-directed IRAs where you can, take an old 401k and roll it over into the purchase of a home. There's a lot of different ways. And there's just, I've got 25 years of mortgage knowledge in my head. So, it kind of just rattles off. But if you're doing this for the first and second time, like you're going to learn a ton. And when I talk to really seasoned investors, it's great. I learn a ton of stuff from them, even after doing it for 25 years. So there is not a set in stone way to do it. But the more of those things you can have in order, the less risky you are. Ultimately, the better financing terms you'll get. The better financing terms you get, the better the property will cash flow for you. Ultimately, the more money you make.
Gotcha. That all makes sense. I do want to get to some of these questions. John, I don't know if you can see them, but the first one that we had come in is, do we do any renovation loans?
So we have a couple of fix and flip loans where you can come in and I'll give you just kind of a generic of how they usually work. Let's say you're going to buy a house for sales price is $200,000. It's kind of dumpy. You think you need to put $100,000 into it. And when you're all said and done, it's going to be worth $400,000. So you come in, we have these kind of programs. You come in, you put your 20% down on the $200,000. And then as you go through and do the renovations, a lot of them will even give you a draw right at closing. So to begin your renovations, you actually get your down payment back, and they give you draws along the way up to the $300,000. And that's usually a fix and flip. There are some that's a fix and hold. So you would do those renovations and you would hold it. A lot of times people will go in and buy them cash and then look to pull money out of them later to kind of do renovations. We have a couple of different ways we can do that. We have one program that's coming online probably within the next 2 weeks where you would actually be able to close cash and pull cash out, begin a cash out application the next day off of the new appraised value. So if you got a property that you feel you're getting a steal on, a little bit of paint, new sinks, light fixture, and, seal coat the driveway, and you got a bunch of extra money, that's a great program as well. So we have a multitude of renovation loans and different ways to work about it. Again, no right and wrong way. It's always the best way for you.
So I find that program really interesting. You can buy a property cash and you can begin the cash out process right away, because traditionally has been like a 6-month waiting period. I actually just found somebody that will do that for us last week. And so we're in the midst of, getting those things approved, but they'll do a no seasoning refinance. It's very odd in the industry. Almost always
you revert back to the original sales price for either 6 to 12 months. Right. So then you're getting cash back out off of the original 200,000 that one scenario was at. Here you can actually get additional money out. But also, if you know that going in that you want to do that, you can do the normal fix and flip loan. We also have another thing that we see some investors doing as they kind of get bigger. We have blanket loans to where we can combine, up to 10 properties all back on one loan. And you can cash that out up to 80%. So if you had 10 $100,000 properties, all free and clear, you could actually get an additional $800,000 cash to go and, do whatever you want. Trip to Vegas, you name it, it's yours to do. Hopefully not the trip to Vegas, but do with it as you would wish.
Nice, that's excellent. We had another question come in. It says, how does it affect if you are a person going into real estate investing for the first time?
Your best bet is to actually just go Fannie Mae, Freddie Mac, traditional mortgage. You qualify with the income. You can still use some of the rental income to offset the payment. And you go that traditional route. You get into it. That's kind of your gateway to becoming a full-fledged investor. And we offer those programs as well.
Gotcha. That makes sense. I got a question. It's actually my own question. Can you use, for a Fannie Freddie loan, can you use both the rental income and your personal income to qualify, or is there one or the other?
No, you actually use both. And okay. They pull the income off of, so on a Fannie Mae or Freddie Mac loan, they'll take, if you own existing, I'll pretend you don't. They're going to use 75% of the projected rent that comes from the appraiser. Will go out in the area and we'll look at other rentals. They'll give you a number. We use a 75% of that. So they assume that it's going to be vacant 25% of it. And that money can only be used to offset the payment. It can't be used as additional income. So you can only wash the payment. You can't, use it to qualify above and beyond that. But again, that's super easy to figure out.
Yeah, it sounds like the key there is the down payment, having the down payment and the credit, and then the income piece is a little easier to figure out. Right?
And in today's market, it's finding the property, right? I mean, that's one of the hardest things is, finding something that's worth buying, the cash flow situation. But none of it's easy, but it's definitely not hard. You're going to have to put a little bit of time into it. But yeah, I don't know. I always say if I can figure it out, right? When I got in the mortgage business, I looked around, I had all these people, right? I'm a knuckle dragon, personal trainer, and I just put my head down. I read Fannie Mae manuals, Freddie Mac manuals, right? I'm not that pretty and I'm not that smart. So I had to just get there by working harder. And I think that anybody that's listening to this is definitely something that the amount of effort you put in will yield you a much greater return. So spend the time, do the research, get out there on Google, dig around things. There's some great forums on Reddit and different places. Just become very curious, and I think you'll do fine.
For sure. I mean, obviously, we have also our own guides to our resource as well. So definitely feel free to reach out.
And I mean, truthfully, if you get I enjoy doing this way more than my day job. This is kind of fun, right? It's talking about things. Maybe we'll get an email or something out with all my contact info or ways to reach me. If anybody has questions, I mean, I'm happy to, I can give you some time. I'm not always available, but I'm happy to answer any questions. You gotta gain, if I can get 5% of your trust, I can gain the rest. So Warren Buffett says price is what you pay, value is what you get. And I think that you get a tremendous value coming back through Beeline today. And every single day, our sales team is getting better at understanding these products, the nuance, how to sell it, how to qualify people, and how not to take you down, a rough road for no reason.
No, for sure. We have 3 more questions that came in. First one, this is an interesting one. When does it not make sense to refi?
I wouldn't say that there is ever a time that it does or doesn't make sense. We've refinanced clients because skipping 2 months payments and getting their escrow back gets them out of a pinch because their kid had a drunk driving and they've got some weird situation and refinancing for the short-term need is so great today that the refinance makes sense, even if long-term it doesn't. And right. That's a risk equation we have to look at individually. I would typically say, if you're in a situation where you can refinance and recoup the cost that you paid. So the actual physical cost, not per diem interest or escrow accounts or those kind of things, where you can recoup the cost inside of 12 to 24 months, I would say that probably makes sense. If you can't, if it's taking you 3 or 4 years to recoup the cost, it may not make sense to refinance. But also, if you're pulling cash out, what are you going to do with the cash? There's a lot of variables there. There are a lot of clients that we talked to today inside of the conventional space. If rates were just a little bit lower, we'd have a loan for them. And we don't want to do anything wrong. Like, our advice is don't do anything at all right now. We're not in a recession today, but we are. Typically speaking, a recession is always followed by a refinance boom. So kind of forever, those things have happened. We've got just an unstable kind of geopolitical world. And I believe, and I don't know this for sure, if I did, I'd be in the Hamptons right now. But I believe over the next, 12 to 24 months, we will see a refinance kind of boom. We'll see mortgage interest rates drop down significantly. Yeah, so 25 years of experience tells me that will happen because I've seen it happen time and time again. And most people sitting out there will get a bite at that apple should they choose to.
Yes, I mean, it's pretty cyclical, right? I haven't been around this space that much, but I've been through one full cycle now, and I definitely see that. So I imagine you'll probably see this coming from 10 miles away.
Yeah, they're not static, right? So, I mean, interest rates are always going up. Interest rates are always going down. We've had a unique situation here, and you can see it in the news with all the layoffs and stuff. Usually there's some component of the market that's still doing really well. So back if you go to 2008 when the whole kind of crisis happened, there was literally 5 million homes on the market and 1 million buyers, right? And there was a 24-month supply of homes. So there was a lot of business out there for those of us in the mortgage space. It was just, you had to wait for the short sale to get approved. So there was a big chunk of business. Right now, we've got a unique thing in that mortgage interest rates have kind of doubled over not that long of a period. So, and a lot of the population, it no longer makes sense, or they're significantly lower currently than where rates are at today. And there's only a 3-month supply of houses. And I know that just ticked up a little bit, but that 3-month supply also includes ones that are already under contract that just haven't closed. So there's just a very small market, and there's not a lot of new builds. Consumer confidence is lower. There was just some builder sentiment that came out, and that dropped by quite a bit. The high was if you're above 50 is a good number. That I think the high was at 88. Don't quote me here. Somebody will say, hey, you got his numbers wrong. But it was at 88, and I think it's somewhere in the 60s now. So builders are not starting as many homes, or there's foundations that are poured. It's just too expensive to build for what they're going to get. So that's there's a lag there. But there will be another refinance boom. There always is. A drought doesn't happen forever. The rain always comes.
Fair enough. Another question we have is, can an investment property be moved into an LLC with a B-line lien on the property?
Yes, pretty much everybody. So when you sign, and that would be more when you do a conventional mortgage. People often will close on a conventional mortgage. They'll close in their own name as their own individual, because a conventional loan, or Fannie and Freddie Mac won't allow an LLC to do it. So they'll move it either into an LLC for liability reasons or into a trust. You as an individual are the ones that signed the loan. What you do after that, Beeline or any lender really doesn't care, because the foreclosure is going to foreclose on the entity that we gave the loan to. So moving it to an LLC or something like that for tax reasons or liability purposes, it doesn't impact us any. We're going to be able to foreclose the same way, and really a lender, what we care, we're relatively insensitive in that they just want to know they can get their asset back.
Fair, that makes sense. And then when we also have programs where you can close in an LLC, so there's no need to do that after.
Almost everything that I've been talking about on the DSCR space, bank statement, there is a whole bunch of programs for investors where we can close inside of an LLC. It's actually probably even preferred. And there's also programs, I don't know if anybody's here, but we have programs for foreign nationals. So let's say you're Pierre living in France, and you have some cash and you want to buy a house here in the U.S., and you have no U.S. credit. You got nothing other than a down payment, and you want to buy a pied-a-terre in New York, you know, to go and visit on the weekends, you can do that. You don't need a credit score. We give you a credit score based on that. You put your, you know, 25, 30% down, and we can give you loans, you know, as a foreign national. So there's programs out there for virtually anyone. And the one thing too that I would just encourage people, often people will call and they'll try and be smart and try and like tell the mortgage person the answers they think they want to hear. And what I would encourage you, if you get somebody good on the phone, give them the whole story, because part of our job as in the mortgage business is to give you the best rates and fees, but it's also to give you the loan that you can close on the quickest with the least number of steps, right? Like to save $8 a month, but if it takes you have to like go and get an audited P&L every year and it costs you $3,000. Well, $8 times 12 doesn't equate to $3,000 every year. So like there are lots of options. There's typically a best option or a couple of best options, but you need to share your overall situation. So don't try and be tricky. We figure it out most of the time anyways.
That's spot on. I mean, I will say, especially when I first started investing in real estate, I will do a lot of research. Like you say, go on Reddit, go on YouTube, go everywhere. And, you know, I thought I knew the right answer, and I would go and talk to a loan officer. I'm like, oh, I need this, so I'm looking for that. But realistically, I didn't know everything that I could have possibly known. And what I learned over time is the more forward I am with what I'm trying to do, and the less I try to be the know-it-all in that case, the more I learn, and the better deal I get.
Yeah, I had a really good example of this. I don't know how we're doing on time, but I had a client come through the other day they were looking for a DSCR loan for like, you know, they were asking all these questions about DSCR, conventional investment property. And then they like one little tidbit said, and what's FHA pricing look like? And I thought it was really weird. And it came to one of my loan guides and they're pricing up all these scenarios. And I said, well, why are we asking about the FHA? So this is a parent, or actually this might be kids trying to buy a loan for a house for a parent, or vice versa. Maybe parents trying to buy a house for a kid. Well, there's programs with 3% down for first-time home buyers. If you've got low income, you can add your parents as a non-owner occupying co-borrower. So all the things that they were looking for were these massive down payments on like investment property loans, where there's an actual program designed exactly for what they're looking for. But you just have to tell people what you're looking for. The worst thing that can happen is you can get told no. But if you don't ask, you will never find out. So actually, I think we have them in process now, and they're doing a 5% down conventional loan. The children were able to qualify in their own name on a program that the government has with reduced mortgage insurance. It's actually encouraging first-time home buyers, and it's great. It's better than significantly better. But had we not caught that little tidbit about FHA, Dad would be shelling out 20%. We'd be jumping through a bunch of it'd just be a whole different scenario. So just be honest. It's always the best policy.
Yeah, and don't be. I mean, this is more from my personal experience. Don't be ashamed not to know. I don't know. I don't know anything. That's the new way of looking at it. When I seek advice from people like John, I just go to them. Hey, I don't know anything about this. Can you explain it to me? Can you talk me through my options? And it makes my life easier. We only got a couple of minutes, and we have 3 more questions that came in. So let's see if we can cover all of them.
I'll go rapid fire. I'll do 1 minute a question.
All right. So I think this will be the easiest one. The question is, do they need a social security number to purchase a property? I'm assuming this refers to foreign nationals buying an investment property.
So we can do them with no social. We can do them with a social, or if they have a TIN, a tax ID number, we can do any of those 3. So.
And if they have an LLC, they'll have an ITIN anyways, right, for the LLC.
So, but usually a foreign national, they're more usually into and you get your best, you're just buying a second home here in the United States. It's usually what you have there, and they want it for that reason. But you do not have to have a social security number. It's actually better to have none than one with one Visa card on it that you use sporadically.
Interesting. Better to not have the credit than to have crappy credit, basically.
If you're a foreign national. Yeah, if you're, yep.
Gotcha. And then the next one is, are there higher rates for an Airbnb, like I said, short-term rental property, than for a single-family condo rental with a long-term lease?
Yes. The Airbnb is slightly more risky because of what I mentioned before. Another pandemic could hit, right? The cash flow is just not as consistent as somebody that signs a 12-month lease.
Makes sense. Back to the risk equals rate equation.
Yeah, it's not terrible. In most cases, I would figure that you're going to pay 1/4 to 0.5% higher in rate, and on $200,000 or whatever it is, you probably will offset it on the cash flows. So the Airbnb is going to, when that thing's up and running, if you're in a good area, should make significantly more money than what you would, on a traditional long-term rental. And there's a couple of ways we look at it. There's a website called AirDNA, which will go in and it kind of like projects those things for you. And different investors will look at short-term rentals from an appraiser. So if it's from an appraiser, it's probably you're getting slightly better pricing than if we're using like a website. But again, there is no right and wrong answer. The market's constantly changing. Like what I say today could change in 30 days if a couple of businesses go out, something bad happens. That's the way it sits today.
Makes sense. All right, last question for the webinar. Is there a limit on the number of mortgages I can take out for investment properties?
No. You can, Fannie Mae, Freddie Mac have limits, but as you get in the DSCR space or the investment space, what you're going to have is some of our investors may have limits with what you can do with them. And then also, I think that you do reach kind of a critical mass where, somebody that's got 200 units, like they're getting financing from a bank. They've got some big balloon thing over it with, a $10 million line of credit. So you will outgrow us before we can stop giving you loans. I guess you keep coming back forever, but most people outgrow us.
Right. But we're still able to do portfolio loans. So somebody that's still growing a certain volume could have still.
Yeah. And that number's probably not until you're at if you start having 25 to 50 properties, right, you're probably just going in and trying to restructure that. There's just more advantageous ways, tax reasons. You may be taking on partners. You just have a bunch of different things. So consult your CPA there.
Got it. That makes sense. All right. We're actually over time now. So we're going to end the webinar. But John's team is available for questions. John, if someone wants to get in touch with you or someone on your team, they can go to our website, makeabeeline.com. How else can they get in touch with us?
Yeah, you can go to makeabeeline.com. If you want to get in touch with me directly, I'll give you my email. It's john@makeabeeline.com. And that will come to me directly. And then I can get, a loan guide in touch with you. We can talk, you and I. Or you can there's an email of hello@Beeline. That's just picked up by a variety of people. So if you want me, it might be better to come straight back through me. But you can go to the website. Lots of ways to get to us, but I am happy to field your questions from this webinar. And you can also find me on LinkedIn and send a message there.
Cool. Excellent. Thank you. And yes, there will be a replay. We'll send out a link. We'll send out the contact information as well after the webinar, probably by tomorrow. And, in the meantime, you can check out the website and go from there. Now, John, thank you so much. I learned a ton. I know people on the webinar did too. Hopefully we can do this sometime in the near future and do a follow-up.
Thank you. They'll probably be demanding that I become the host. So you may be out of a job now after I did so well on this.
Listen, that will be a success. So I'm good with that. I'm going to thank you everyone for joining, and we'll see you on the next one.
Great. Thank you.